What if the number you've been afraid of all these years is not the real danger at all? A lot of older people hear the same warning over and over. Never keep more than $10,000 in savings. If you do, the bank will flag you. The government will come looking. Your money will be frozen. Your account will be watched. That kind of talk spreads fast because it sounds scary. And when money is involved, scary stories stick. But here's the truth. The number itself is not the whole story. In fact, many seniors are focusing on the wrong risk. They get nervous about having $10,001 in the bank, while the real problems are happening somewhere else. Low interest, too much cash in one place, wrong account setup, big deposits handled the wrong way, and money sitting still while your bills keep moving up. That is why this matters. I started making these videos because an older relative of mine once made a money decision based on fear instead of facts. She was trying to be careful. She thought she was protecting herself. But in the end, that fear cost her more than the problem she was trying to avoid. I don't want that happening to you or your family. So if these videos help you feel calmer and clearer, subscribe. I'll keep making them simple. Right now, there are probably two kinds of people watching this. The first person has had more than $10,000 in the bank for years and feels a little nervous every time they hear someone say that amount is dangerous. The second person has been breaking up deposits, moving cash around, or avoiding the bank because they think crossing that number will cause trouble. If you're either of these people, you're in the right place. Here's what most people never learn. The system is designed to do exactly what the rules say, nothing more, nothing less. Nobody is calling you to explain the difference between a bank balance and a cash transaction. Nobody is checking to see if your savings account is paying you almost nothing while prices keep going up. Nobody is fixing your account setup so more of your money is protected. It's all on you. The good news is you can fix a lot of this once you understand what the real issue is. I'm Daniel. I've spent more than 20 years helping seniors understand their money, and I've seen people lose thousands of dollars simply because nobody explained the rules in plain English. Over the next 20 minutes, I'm going to show you what that $10,000 warning really means, why so many people misunderstand it, and what you should actually do with your savings right now. I'll give you real examples, real dollar amounts, and simple steps you can take today. By the end, you'll know exactly what deserves your attention and what does not. First thing you need to know is this. A lot of people think having more than $10,000 in your savings account is the problem. It usually isn't. The real issue is how money moves, especially cash. Let me slow that down. If you have $12,000 in a savings account and it's been sitting there for months, that is very different from walking into a bank with more than $10,000 in cash and making a deposit. Those are not the same thing. Not even close. Banks pay attention to large cash transactions because they are required to report cash activity over certain amounts. Cash means actual paper money and coins. It does not mean your account balance. It does not mean your Social Security deposit. It does not mean a check from selling your car. And it does not mean the bank is accusing you of doing something wrong just because you have savings. This is where people get tripped up. They hear one sentence from a neighbor, a son-in-law, or somebody online, and they turn it into a rule that sounds like this: never let your account go over $10,000. So they start doing little moves. They deposit $4,000 one week, $3,000 the next week, $2,500 after that. They think they're staying under the radar. But that kind of behavior can create more questions, not fewer, because it can look like you are trying to avoid normal reporting. Let me give you an example. Say you sold an old truck for $11,200 cash. You come home, put the money in a drawer, and then start worrying. Someone told you never to put more than $10,000 in the bank. So instead of making one honest deposit, you break it into three smaller ones. Maybe $4,000 on Monday, $3,700 on Thursday, and $3,500 the next week. That feels smarter in the moment. But it can actually look worse than simply depositing the money and letting the bank do what it is supposed to do. The real lesson is not never keep more than $10,000. The real lesson is don't make money decisions based on rumors. A lot of seniors lose peace of mind over a number that means one thing in one situation and something very different in another. If your savings account has $18,400 because you've been careful and you built a cushion for home repairs and medical bills, that does not mean you did something wrong. It means you saved money. Now, if you have a very large amount in cash sitting at home because you're afraid of the bank, that is a different risk. That money can be stolen, lost, burned in a fire, or taken by a scammer. I've seen older people keep $15,000, $20,000, even $40,000 in envelopes, drawers, and closets because they misunderstood the rules. That is not safety. That is exposure. Here's what to do about this right now. If you've been avoiding the bank because of the $10,000 rumor, stop and separate one question from the other. Ask yourself, am I worried about my account balance or am I dealing with a large cash deposit? If it's a cash deposit and the money is legitimate, handle it honestly. If it's just a balance sitting in your account, don't panic over the number alone. Second thing, the amount that should really get your attention is often not $10,000. It's $250,000 at one bank in one ownership category. Now, I know that may sound strange. Most seniors watching this are not sitting around with $250,000 in savings. But stay with me, because this matters even if you have much less. A lot of people worry about the wrong ceiling. They keep repeating $10,000, while the bigger question is whether their deposits are protected if a bank fails. For most regular deposit accounts, the standard protection amount is $250,000 per depositor per insured bank per ownership category. That means if you have money in a checking account and savings account at the same insured bank under the same single ownership, those amounts are usually added together for that coverage category. Let me make that plain. If you have $140,000 in savings and $90,000 in checking at the same insured bank in your name only, that adds up to $230,000. You are still under $250,000. But if you have $180,000 in savings and $95,000 in checking in your name only at the same bank, now you're at $275,000. That means $25,000 may be above the standard protection amount in that ownership category. That is a real bank number to pay attention to. And here is why this matters for seniors. Sometimes money piles up quietly. A home gets sold. A spouse passes away and accounts change. A retirement fund gets moved. An insurance payout comes in. A certificate of deposit matures. Suddenly, someone who usually kept $30,000 in the bank now has $268,000 sitting in one place and never thinks to ask whether all of it is protected. I worked with a man who sold his house after moving into a smaller place near his daughter. He had about $312,000 from the sale sitting in one bank because he planned to deal with it later. Later turned into 5 months. He was not reckless. He was tired. Moving had worn him out. He assumed a bank account was a bank account. Nobody had ever explained that how the money is titled and where it is held matters. That is why I tell seniors this all the time. The risk is not having more than $10,000 in savings. The risk is not knowing what kind of protection you actually have. And even if you're nowhere near $250,000, this still teaches you something important. Do not let fear choose your money moves. Let facts choose them. For example, a married couple might have more room depending on how accounts are set up. A joint account is not the same as a single account. A trust account with beneficiaries may be treated differently too. The point is not to memorize every rule. The point is to know that account ownership matters. You're doing great. Most people click away by now. You're still here. That means you care about getting this right. One woman I know kept 4 different savings accounts at 4 different banks because she thought anything over $10,000 would trigger problems. She had $46,000 total. Not one of those accounts was earning much. She spent years worried about nothing, filling out extra paperwork, driving all over town, and making herself anxious. What she needed was not 4 tiny accounts. What she needed was one calm explanation. Here's what to do about this right now. Add up your checking, savings, and CDs at each bank and look at how the accounts are owned. If you want to check your coverage, use the deposit insurance tool at ed.fdic.gov or talk to your bank and ask how your accounts are titled and how much is protected. Third thing, the biggest danger for many seniors is not that you have more than $10,000 in savings. It's that you're leaving too much money in a low-paying savings account while prices keep rising. This is the quiet loss. No alarm, no warning, no scary letter in the mail. Just money that slowly buys less and less. And because the number in your account doesn't go down, it feels safe. That is what makes this so tricky. You open your statement and still see $12,000 or $22,000 or $58,000. So your brain says, good, I still have it. But what that money can do for you is shrinking if the interest is tiny and your costs are climbing. Let me give you a real example with simple numbers. Suppose you have $50,000 in a basic savings account earning almost nothing, let's say 0.10%. Over a year, that gives you about $50 before tax if the rate really stays that low. That sounds almost silly because it is. Now compare that with what happens if your everyday living costs rise by just 3%. I'm not talking about anything wild, just normal pressure. Groceries, electric bills, insurance, medicine, gas, home repairs. If your costs on that amount of money's buying power rise by 3%, the gap is huge. Your $50,000 may still say $50,000 on paper, but it does not stretch like it used to. Think about one simple basket of monthly bills. Maybe last year you were paying $220 for groceries each week, some weeks, and closer to $190 on others. Maybe now the average feels more like $250. Maybe your supplemental insurance went up $27 a month. Maybe your property insurance jumped $340 for the year. Maybe a prescription that used to be $18 now costs $34. These changes don't arrive all at once, but together they eat into what your cash can do. That is why some seniors feel confused. They say, I have more money saved than I used to, but I feel tighter than ever. Yes, because the number stayed still while life got more expensive. I know this might feel like a lot, but trust me, once you see the whole picture, it gets easier. Keep watching. Now, I am not telling you to put all your savings into the stock market. Not at all. At this stage of life, safety, access, and sleep matter. You need money you can reach. You need money that doesn't swing up and down every day. But there is a big difference between safe and asleep. For many seniors, a plain savings account should be a parking spot for near-term money, not the whole house. Your emergency cash, yes. Money for taxes, car repairs, dental work, or home repairs, yes. But if you have $80,000 sitting in one low-paying account for years and years because nobody ever helped you think it through, that deserves a second look. Let's say Ruth keeps $30,000 for emergencies and another $40,000 just because it feels safe. That's $70,000 total. If she needs quick access to maybe 6 months or even a year of living costs, fine. But if part of that money is truly long-term and still sitting in the same sleepy account year after year, she may be giving away more than she realizes. This is where some people make a mistake in the other direction. They hear that low interest is bad, so they jump into something they don't understand. No, that is not the answer either. The goal is not to chase. The goal is to sort. Money you need soon belongs in safe, liquid places. Money you don't need soon may deserve a different home, and money sitting in one old savings account just because it has always been there should at least be reviewed. Here's what to do about this right now. Look at your savings account statement and find the interest rate, not the balance, the rate. If the rate is tiny and you've been leaving more than your real emergency cushion there for a long time, make an appointment with your bank or credit union and ask what insured savings options or short-term CDs they offer that still let you sleep at night. Are you still with me? Good. Let's keep going. Last thing. If you keep too much money in one easy-to-reach savings account, you may be making yourself a bigger target for fraud, mistakes, and emotional decisions. This one hurts because it happens to good people. When money is sitting in one simple account with a debit link, online access, automatic transfers, and easy movement, it is convenient. And convenience is wonderful until the wrong person gets near it. Maybe it's a scam caller who sounds helpful. Maybe it's a fake fraud alert text. Maybe it's someone pretending to be your grandchild. Maybe it's a romance scam. Maybe it's just you having a tired day and moving money too fast because somebody pressured you. The easier the money is to move, the easier it can be to lose. Let me show you what I mean. Suppose you have $26,000 in one savings account linked to your checking. Your phone rings. Someone says there's suspicious activity. They sound calm. They know your name. They know your bank. They tell you to move money to a safe account while they investigate. It sounds official. You're nervous. You do what they say. Now imagine instead that you kept $8,000 in your easy access savings for normal surprises, $12,000 in a separate insured account you don't touch often, and another amount in a CD or other safer bucket with more friction. That setup does not make you scam-proof, but it can slow you down, and sometimes slowing down saves people. I once spoke with a widow who lost $9,400 in one afternoon because all of her extra money was sitting in one place, ready to move. She was not foolish. She was lonely, tired, and scared by the way the caller spoke to her. If the money had been split into buckets with a little more distance between them, the story might have ended differently. And scams are not the only danger. Big, easy balances can lead to family pressure, too. An adult child needs a short-term loan. A nephew wants help with rent. Someone promises they'll pay you back in 3 months. Maybe they mean it, maybe they don't. But when the money is sitting there, visible and available, it becomes easier to say yes in a weak moment. There is also the risk of your own emotions. A sudden home repair estimate of $14,000. A car salesman talking fast. A contractor pushing you to decide today. When too much money is sitting in the easiest place to grab, mistakes get easier. Does this make sense so far? If something is unclear, keep watching. I'll explain it again in a different way. The strongest example I can give you is this. A couple had about $92,000 sitting in one old savings account because that's where the pension used to go. Over time, they used that same account for everything. Their daughter helped them with online banking. Their grandson knew roughly how much was there. When the husband got sick, bills and transfers started happening fast. By the time they stepped back and sorted it out, there had been confusion, pressure, and a few decisions they deeply regretted. No one robbed them in the old-fashioned sense, but the money was too exposed, too reachable, and too mixed together. Here's what to do about this right now. Stop thinking only about how much savings you have and start thinking about layers. Keep your true short-term emergency money in one easy place. Keep extra protected cash in a separate insured place. And do not leave large amounts in the most convenient account just because it feels simple. Okay, you've made it this far. Most people don't. Let me give you two more things that work alongside everything I just explained. First bonus thing, keep a written money map. This is so simple, and it helps so much. Write down the name of each bank, the last four digits of each account, what that account is for, and roughly how much should usually be there. Not the exact penny count every day, just the purpose. For example, checking for bills, savings for emergencies, CD for next year's roof, joint account for monthly household needs. Why does this help? Because confusion is expensive. If something happens to you, your spouse or adult child has a cleaner picture. If you get a strange bank alert, you can tell right away whether it matches your normal setup. If you are ever in the hospital for a few days, someone you trust can help without turning your whole financial life into a mystery. Here's what to do about this right now. Take one sheet of paper tonight and make a simple list of your accounts, their purpose, and one trusted person who knows where that list is kept. Second bonus thing, never make a money move on the same day that fear enters the room. That includes fear from a phone call, a text, a scary headline, a rumor from a friend, or even this topic right here. If this video made you realize you need to adjust something, good. But do not rush and throw your whole money setup into chaos by dinner time. Fear creates bad timing. You hear $10,000 and suddenly you want to withdraw money, open 5 accounts, move money around, or hide cash at home. No. Slow down. Think. Check. Then act. I've watched seniors make fast changes that solved nothing. One man withdrew $14,000 because he thought the bank was going to report him just for having it there. 3 months later, that money was sitting in his house while a caregiver, a repairman, and 2 relatives all came and went. He had traded one imaginary danger for 3 real ones. Here's what to do about this right now. If you feel urgency, wait 24 hours before moving a large amount unless there is a true emergency. Use that day to confirm what problem you are actually solving. So let me make this simple. What I just showed you is that the real danger is not the plain number $10,000 sitting in your savings account. The reason it matters is that fear around that number pushes people into bad choices, while the true risks are misunderstanding cash rules, ignoring deposit protection, leaving too much money in low-paying accounts, and keeping too much in one easy-to-reach place. The action you need to take is review your savings setup with a calm head and make sure each dollar has the right job. That's it. One step. Do it today. If your money is in the bank, ask three simple questions. Is it protected? Is it earning enough for the kind of account it is? And is too much of it sitting in the easiest place to reach? If you answer those three questions honestly, you will already be ahead of most people. And let me say one more thing from the heart. You do not need to be embarrassed if you believe the $10,000 story. Many smart people do. They heard it from someone they trusted. They repeated it because they wanted to stay safe. But now you know better. And knowing better is how you protect yourself. Your money should give you stability, not constant worry. Your savings should serve you, not scare you. And your bank account should be something you understand, not something you tiptoe around. One thing before you leave this page, think of one person in your life who needs to hear this. Maybe it's your brother who still keeps cash in the house. Maybe it's your neighbor who gets nervous every time the bank asks a question. Maybe it's someone from church who still thinks having $10,001 in savings is a problem all by itself. Send them this video. One share could save someone a lot of worry. That's all I'm asking. Next time, I'm going to show you the quiet checking account mistake that causes some seniors to pay hundreds of dollars a year in fees, overdrafts, and missed interest without noticing until it's too late. I'll see you then.